Hello, welcome back to another video. I hope you are having a great day. And without further ado, let's talk about market participants and their roles. So, when you place a trade, it can feel like you're just pressing a button and then you're buying a stock or selling a stock, whatever you may be, right? But there's actually a massive network of people and institutions behind that one trade you're placing. There are individual investors, massive funds, brokers, market makers, trading firms, regulators, and a lot more. They all have different goals, different amount of money, and different reasons for trading. So in this lesson, we're going to explain who these people are and what they're actually doing inside the market and why it matters. So let's get into it. Stock prices do not appear on a screen just by themselves. Every price comes from buyers and sellers around the world and in the market. One person might be saving for a retirement fund and planning to hold a stock for 30 years. At the same time, a large fund might be moving billions of dollars while trading firm reacts to new information in a fraction of a second. All of these participants are trading in the exact same market, which is why it gets interesting. So, the price you see on your screen is just really the result of people with very, very different goals agreeing to trade at a certain price. So let's talk about the main group, aka the retail investor. This is the group that most of us belong into. A retail investor is someone who is just simply trading their own money. It's like probably me and you, or a regular person, a regular working person. It could be anyone, but it just really just individual people. They might be buying a few shares, contributing to a retirement account, or managing their own personal portfolio. Retail orders are usually pretty small compared with orders by professional institutions, but being small can actually be extremely helpful because they can buy and sell without moving a stock price, without notably moving a stock price. And even though retail investors are extremely small, they still use the same general market system as everyone else. They place orders to brokers, and those orders enter the wider market. So, right now, this is probably where you fit. Now let's talk about the next type of person, which is the institutional investor. Institutional investors are organizations that manage large pools of money, usually for other people. A mutual fund might invest from thousands of savers. A pension fund might invest monies for workers' retirements. Insurance companies invest the premiums they collect. University endowments invest money to support a university over long term. These institutions control millions, billions, and even sometimes trillions of dollars. Not like a retail investor with a couple shares. We're talking billions and trillions of dollars. Because they manage so much money, institutions account for a major amount of activity in these financial markets. Their size gives them more resources, but also creates a bunch of problems that retail and other small investors do not have. And the big one is the amount of shares. Buying 10 shares is not the same as buying 10 million. If you buy 10 shares, the market will notice. Someone will sell 10 shares easily. But imagine a large fund trying to buy 10 million shares at once. Okay? Other traders can see that huge demand and start asking for higher prices. This is why institutions usually split large orders into smaller prices, because you have to be somewhat realistic. No way 10 million shares is so many shares. Chances are they're not all going to get filled immediately like 10 shares would, which would cause a demand for buying shares, which would raise the stock price, meaning other investors would want a higher price too. So, they may buy gradually over several hours or even several days. And some use algorithms to make their activity less obvious to other investors. So institutions have more money and technology technically, but they cannot always move as quietly as a small retail investor can because they're just managing so much more money and buying so many more shares. So let's talk about who connects the trades. Most investors do not call another investor to ask to buy their shares. I'm not going to call someone and say, will you send me this share for $10? That's not how the financial markets work. And we've talked about this before, but they use something called brokers. And a broker helps an investor connects trade. So a broker sends a client's order into the market. So when you place an order through a brokerage app, the broker helps route the order and find a place where it can be completed. A dealer, however, is different. A dealer trades using the firm's own money, and a broker-dealer can do both. In one situation, the firm may be acting for a client. In another, it may be trading for its own account. So that's basically it. You don't have to master this perfectly because we're going to talk about it later in this unit. But just know that brokers help connect investors, help connect different orders. So if you want to buy something, you send it through a brokerage. You don't actually talk to an investor and get them to do it on the stock exchange, while a dealer trades using their own firm's money. So let's talk about market makers. Market makers are a pretty important, but also a little confusing process because they're kind of different. Um, we're gonna dive more into this in later lessons, but for now, I'll explain why they are important. They are extremely important because they help make it possible to trade quickly. A market maker regularly quotes two prices: the bid, which is what you're willing to buy it for, and the ask, which is what you're willing to accept to sell it. So the bid is what an investor would want to buy something for, usually the cheaper end. And the ask is what an investor wants to sell it for, usually the more expensive ask, usually the more expensive side, right? And that makes sense. Buy for cheap, sell for expensive, and make the profit. And the difference between the bid and the ask is called the spread. Market makers earn a tiny amount from the difference across a large number of trades. But their bigger role is providing liquidity, which we talked about several times. Because they are standing ready to trade, buyers and sellers do not have to wait around forever for the perfect person to appear. That is why you can place a stock order and have it filled almost immediately because of these market makers. Let's talk about proprietary and high frequency traders. Some firms trade their own money using mathematical models, optimization, and speed. These are often called proprietary trading firms. Some of them also use high frequency trading strategies. They may search for extremely small opportunities that only exist for seconds or even less. So, these high frequency trading firms, they're not looking for one massive profit. Instead, they're looking for a pretty small profit, milliseconds, but thousands and thousands and thousands of times in minutes. It could be however fast they want it to be. They make small profits, but extremely, extremely quickly, which adds up to a bunch of profits in the long run. These are some of the firms a quantitative trader may eventually compete with. But that does not mean every quant strategy needs to be the fastest in the world. Some strategies operate over multiple days, months, or even years. It just depends on what trader you're competing with and what time period you're working with. Now let's talk about regulators. Regulators are normally not the people on the side of a trade. Instead, they oversee the system. In the United States, the best known regulator is called the SEC, Securities and Exchange Commission. Regulators investigate things like fraud, insider trading, market manipulation, and misleading information from companies. Markets don't involve risk, and regulators cannot prevent every bad outcome. But without rules and enforcement, investors would have far less reason to trust the system, which is where these regulators come in by providing trust. So regulators are not buying and selling alongside with you. They're actually watching the market and enforcing the rules that participants are expected to follow. For example, the Securities and Exchange Commission, which was born out of the Great Depression in the United States to help rebuild investor trust, to get investors to go back in the market. That's why these regulators exist, to build trust and enforce the rules and regulations in these markets. So, where would you fit in the system? If you're investing your own money, you're probably a retail investor. If you rely on a broker to send your order into the market, you may also rely on a market maker to provide a price and allow your trade to happen quickly. And the person on the other side could be literally anyone. Another retail investor, a mutual fund, a hedge fund, or even an automated trading algorithm. That's a computer trading, not even a real human. The important thing is that the person selling you may have a completely different reason for trading. They might need cash, reduce risk, rebalance the portfolio, or simply disagree with your view of the stock. So, let's talk about the big takeaway now, as we've done in our past lessons. The big takeaway is that financial markets isn't just one person. It's a bunch of different participants. Retail investors who manage their own money, institutional investors who manage large pools of money and can sometimes move markets because of the amount of money they're managing and the amount of money they're buying into different financial assets. Proprietary trading firms use their own money, often with technology and automated strategies. Brokers and market makers are the reason why you're able to buy a stock or buy shares or sell shares so quickly. And regulators oversee the system and enforces the rules of that system. So, whenever you place a trade, you're competing with some of these participants and relying on others. So, understanding this is extremely important and makes the market feel much less mysterious, and you actually know more about what you're doing. We talked about a lot of different people like hedge funds, market makers, which we'll dive more into different lessons in these units. But for now, the big key idea is there's retail investors, which people are making small trades. There's institutional traders like hedge funds and mutual funds, which are the people who are buying millions and millions of shares at a time or trading strategies or whatever they may be doing. There's market makers, which are people providing liquidity and working on the bid-ask spread. And there's regulators, which are the people who oversee the system and actually enforce the rules. So that's this lesson. I hope you enjoyed it, and I hope you have a great day, and I'll see you in the next one. Bye-bye.